Part 2 of the series. This is Ken Finnan at part 2 of this series 24. Quick and dirty. Okay. We have a couple of things to do before we get. We are doing trading. Okay. So now, remember, this is all random shit that's going to help you on the test. So it's an ADD fest. Okay. Order tickets must be prepared before execution. That makes sense. You can't prepare an order ticket after execution. That would be a problem. If you have a numbered or coded account, trade confirmations only need the account number. You don't need the customer's name because it's a coded account. Remember, a not held order has to be a day order. You can't roll it into it can't be rolled into a second day. Also, GTC orders, good till cancel, which means they're good until the end. They have to be listed on the client's statement. Okay, the quarterly statement, you have to list the good till cancel orders that are open. Okay. If you have a CMO trade confirmation, it has to have the full name of the security, the specific tranche, the price, the nominal or notional interest rate, and the original notional or nominal face value. Okay, so again, for a CMO, collateralized mortgage obligation, trade confirm has the full name, the specific tranche you're doing, ABC, whatever it is, the price, the notional or nominal interest rate, or the notional and the notional or nominal face value. Okay. If you have a customer account statement, broker-dealers must disclose estimated values. For non-listed and non-traded REITs, you got to give some sort of estimated value. You can't just have it roll and be like, hey, it is worth. Okay. Now, they can do, so non-traded REITs, they can do the value. They can do the net investment method, which is basically they're going to value it within 150 days after the anniversary. Who cares? So you can either do net investment method, which is what we invest, or the appraised value. We have a third party appraise them. Because the problem with non-traded shit, you don't really know what it's worth. So you kind of have to figure out what it's worth. So that causes problems. So we have to make sure non-traded shit, all different stuff. Okay. Now, if a client invests in a DPP, you have to tell them that distribution not guaranteed and the program can change the distributions. There's no guarantee on distributions and they can be modified. Also, remember, even if you have discretion, is more of a 7 thing, but it could be on here. Even if you have discretion, before you can put someone in a DPP, you need written approval. Okay. If any kind of checks or statements, you must show information about both the clearing firm and the introducing. I can't speak. So if you have an oh my God, I can't speak. So any kind of checks and statements have to show the clearing firm and the IB, the introducing broker dealer. Okay. Now remember, if I'm acting as a fiduciary for an issuer, like I'm going to help with proxy delivery or shareholder accounts, I cannot use that shareholder list to solicit new business unless the issuer allows it, which they won't. So I'll say that again. If I'm a broker dealer and for somehow I have the list of shareholders because I have to help deliver proxies or something like that, I cannot then use that list to solicit. Whether they do or not, I don't know, but you're not supposed to. Okay. Now, you have to give the broker check phone number and website at least once a year. Broker dealers have to give the customers broker check phone number and website at least once a year. After a trade, the confirmation must be at or before the completion, which is T+1. So before the transaction is completed, any kind of confirmation has to be sent by at or prior to completion, which is T+1 settlement. Okay, if a broker dealer fails, SIPC handles a customer claims. And remember, they are valued. I've seen this all over the place. SIPC, because it's bankruptcy, not fraud. Remember, bankruptcy, not fault. Like if the broker-dealer bankrupts, not the issuer. If the broker-dealer goes bankrupt, SIPC covers it. Now, they will value the securities at the day that either the executor is named or the administrator is named or when they file for bankruptcy at the court. So basically, it's not when you claim, it's when the broker-dealer files a bankruptcy claim or there's a trustee named or whatever, however they want to say it, that's the day they evaluate the securities. Okay, now, there's a 5% commission guideline. It's basically a guideline, not a rule. It's just to follow it. Now, remember something. If you buy shares in an active market, they will evaluate the 5% based on the offer. If it's a sale, they'll evaluate it on the bid. Remember that, on the offer versus, so if the market is 40 by 42 and I buy stock, they're going to base the commission, 5% rule, markup commission, on the 42 because that's where I could have bought it. Just because I sell to them at 43 and if I'm offering at 43 and I sell to them at 43.05, it's not based on my offer, it's based on the inside market. So again, hold on. So if we have an inside market of 40 by 42, and we're offering 40 by 43, so we're not on the inside on the offer. If I get a buy order, I'm going to base it on I would think I would base it on the 43, but I can't. I base it on the 42. So if I charge them, if I sell to them at 43.05, right? I can't say it's a 5-cent markup. I have to say it's $1.05 and then divide that by 40 and see if it's over the 5%. That's how you do it. And that's on the sell side, you base it on the bid. That's in an active market. If it's inactive, it's on contemporaneous trades, like where it's been trading. If it's a dominating control, we're the only market maker, it's based on contemporaneous dealer cost, where basically either dealer incurred the cost of the stock, as long as new news would come out. Contemporaneous means recent, like fair, within reason. It's going to be based on that. So again, active is based on the inside market. Inside ask for a buy, inside bid for a sale. If it's inactive, it's going to be contemporaneous trades, where it's trading. And then for dominating control, where you're like the only market maker, it's based on dealer cost. Risk as principal is where you get an order from a customer, they give you an order to buy, you buy or sell, that you buy it in the market, and then you flip it out and sell it to them with a markup, and you disclose the markup. A net basis trade, and you have to disclose the markup. One trade shows up on the tape where you bought it, not where you sold it to the customer with the markup, because remember, the tape does not include markups or commissions. Net basis trade is, I give you an order to buy stock, you sell it to me. You give me an order to buy stock, I'll sell to you at 21. I only tell you bought it at 21. I don't disclose the markup, so that causes problems. So here's what we do. If it's a retail customer, I have to get permission every single time I do it. If it's an institutional customer, I can get what they call a negative consent letter when you open the account. I say, by the way, I do net basis trades. If you have a problem with it, let me know. That's negative consent, meaning if you don't say anything, you're okay with it. So if I either have to tell the institution every time I do it, or get a negative consent letter when I first set it up, and then we're good to go. Okay, now a couple more issuer stuff, and then we're into the more trading. Under my SOX, Sarbanes-Oxley, the CEO and the CFO must certify the accuracy of information in the 10Qs and 10Ks. So basically, prior to this, the CEO go, well, I didn't know it was on it. Now they have to verify the accuracy so that if it's a lie, they're on the hook. Okay. 10Ks get audited, 10Qs get reviewed by the auditor, not audited though. If a corporate insider receives restricted stock to the 401k, okay, so if a corporate insider gets restricted stock to the 401k, they don't report it on the 4 because it's on the 401k. Now, if you do a forward-looking statement like a projection, it must include cautionary language about the risks, whether they appear in a prospectus or elsewhere. So if a issuer puts out a forward-looking statement, it must say, listen, you got to be careful. This may not happen, blah, blah, blah. You have to list the risks. Okay, now, Form 3 is when somebody becomes an insider. Form 4 is when you change your position as an insider, and you get it through buying or selling. And Form 5 is when you get more shares through like stock options or incentive options, stuff like that, where you didn't get it from buying more shares in the market. Now more to the trading. Reg M. M as in manipulation. Okay, I have videos in this, so I'm not going to go heavy into this. Reg M is manipulation. Remember, Rule 101 is for underwriters who are market makers if they're going to withdraw. So remember, Reg M says people involved in the deal, underwriters, issuers, stuff like that, cannot, or selling shareholders, cannot bid, buy, solicit bids, or induce others to buy during the restricted period. And you can look this up, but it's either 0, 1, or 5 days. If it's small, it's 5 days. If it's mid, it's 1, mid. Or if it's big, it's 0 days. But that's 101 defining the restricted period. And any underwriter who is not going to become a passive market maker has to withdraw their quotes for that period because they can't bid. 102 is for issuers and selling shareholders. They cannot buy, bid, or their own shares. There are exceptions. Again, I have a Reg M video on this. Go watch it. 103, you passive market makers. This is you cannot be any higher than the highest independent bid unless it's an unsolicited customer order. Right? So I can bid higher than the highest independent bid as long as it's an unsolicited customer order. But if not, I can bid the highest independent bid, and if they drop, I can buy 200 shares and then drop 2. And I can't buy more than 30% of my average daily trading volume in that stock. Okay. So passive market making is allowed up to the daily purchase limit. 104 is about stabilizing bids, okay? They're allowed for fixed price offerings on a firm commitment basis. They can have a penalty bid or a not penalty bid, depending on how we do it. So if I enter a stabilizing bid and one of the independent market makers lowers their bid, I can stay. Remember that. So if I enter a stabilizing bid to hold the price, as long as it's not higher than the POP, which I can never do, if another market maker drops their bid after I already did it, I can stay there. Unlike passive market making, where if they drop, I drop, you drop, we all drop. Okay, now, 105 is for manipulative short sells. It is for 5 business days before the offer date. You cannot short shares within 5 days prior to the offering price and cover your short by buying at the offer. That's the deal. You can, if it's inadvertent, you can, as long as you cover a day, at least 1 day before the offering, you're fine. Cover means you have to flatten out and be not short anymore. So if you're a short stock within 5 days prior to the offering, then you cannot buy in the offering. Okay. A research analyst whose firm is involved in a non-EGC. So remember, EGC, Emerging Growth Company, they did a video on this. Research analysts can attend the IPO pitch meeting. If it's a non-EGC, the research analyst cannot. Yes, they can watch on a one-way closed circuit thing, but they cannot be there. A research analyst can buy mutual fund shares even if the funds hold the stock. That fucking makes sense. A research analyst serving as an UTMA custodian. So if you're managing it for UTMA account on your research analyst, you cannot buy stock for that account if you have a sell recommendation. That makes sense. If you have a sell recommendation on a stock, you can't buy the stock for yourself or for an UTMA account. Under Reg FD, if a material non-public info leaks for late Friday, it must be released publicly before the market opens on Monday. 100%. Okay. If a newsletter sent by a registered rep contains opinions, recommendations, or in-depth stock info, it is considered a research report and must be approved by a principal, usually a Series 16. Remember that. So if a newsletter sent by a rep contains opinions, recommendations, or in-depth stock info, it is considered a research report and must be approved by a principal, usually a 16. Okay. Now, IPO is 10 calendar days for all underwriters. That's for sure. Unless it's an EGC, then it doesn't matter. If it's an additional offering, then it's only 3 days for the managers, everyone else. So I'll say that again. If you do an IPO, everyone has a 10-day blockout period. On the follow-on, it's only the managers and co-managers that have a 3-day blockout on doing research. Okay. EGC is not subject to IPO quiet periods. So non-EGCs are subject to the quiet period. EGCs are not. Jobs Act says that if you have $1 billion or more in revenue, you're a non-EGC. Okay. Roadshow, a research analyst cannot be there unless they're separated from investment banking personnel. Usually that's what I mean by they can watch on a closed circuit TV. Okay, so during a public appearance, the research analyst must disclose any compensation received from the subject company in the last 12 months and any financial interest by the analyst of the household, including the specific nature of that interest. Okay. These are just one-hitters. So Act of 33, the Paper Act, governs the registration for non-exempt securities. You can take indications of interest during the registration period, but no money, no moans, baby. No money, no orders, no money, no orders, no ads, no solicitation. Now, again, you can do a tombstone during this time, but but you can't do ads or that. Even though a tombstone sounds like an ad, it's not an ad. Okay, even if a mutual fund has been registered for 5 years or more, every time somebody buys a mutual fund, they get a prospectus. Remember that. If a mutual fund has been registered forever, no matter what, anyone who buys shares has to get a current prospectus because it's a new issue. It's like an IPO. Every time you buy a mutual fund, you're getting an IPO. The Act of 34 governs the registrations of persons and exchanges. It covers securities information processors and transfer agents. So understand, I have misperms. It covers manipulation, insiders, SEC, short sales, proxies, exchanges, reports, manipulation, and stabilization. I have videos on that. Okay, so Underwriting. Again, this is all over the place, baby. A syndicate is formed with a lead underwriter, or what they call a statutory underwriter. The agreement among underwriters spells out each firm's participation. All or none or mini-max offerings. You should know all this shit. All or none or mini-max use an escrow account. Okay, a free writing prospectus can be used to market new issues before a final prospectus is ready, only for pretty much WKSIs and well-known seasoned issuers. If you receive securities as underwriting compensation, they're restricted for 6 months from the effective date. Remember that. Securities received as underwriting compensation are restricted for 6 months. There's no free stock. That's what they call it. Okay. Issuer employees who help distribute a new issue are treated as agents. So if you work for an issuer and you help distribute a new issue, you're treated as an agent. Okay, if you're a firm that you have investment banking, research, or arbitrage, you must have a restricted and watch list so securities that employees can't trade. Remember that. If you invest in banking, research, or arbitrage, it makes sense. You have a restricted list and a watch list of securities that they can't trade because they have to. You got to make sure that they're not front running, the insider trading and stuff like that. A member private offering is when a member firm raises capital for itself or some firm they own more than 50%. All the disclosures and retail communications have to be filed with FINRA, obviously, and you will need an IQU, an independent qualified underwriter, to make sure that the deal is fair. Now, if you have to deal with the CFD, the Corporate Financing Committee, the firms, and there's exceptions, find the fucking exceptions. Firms must file info with them to prove fairness of the underwriting compensation. The manager must file within 1 business day of filing the registration statement. The CFD does apply to both equity and convertible because convertible is considered equity. Non-convertible debt and non-convertible preferred stock are exempt if they're investment grade related. Okay. Where they're looking for things like freely transferable stock, unlocked up. Options or warrants that are more than 5 years. Those are like excessive. Options or warrants with an exercise price below the POP. So they're looking for like unreasonable terms, right? Free stock that you can sell right away, no good. Options or warrants more than 5 years, no good. Options or warrants with an exercise below the POP, no good. Okay. Now, what can an issuer reimburse underwriters for expenses? Registration fees, accounting fees, FINRA filing fees, and prospectus. Now, a fairness opinion. When you have a fairness opinion, the firm must disclose if the firm was a financial advisor to any part of the transaction and if compensation is contingent on completing the deal. Okay? We have to know in a fairness opinion if the firm was a financial advisor to any party in the transaction and if compensation is based on completing. Any relationship the firm had within the past 2 years with any party involved and whether the compensation was or will be received. If any information used to form the opinions was supplied by the requesting party and whether or not it was independently verified. So again, if I'm doing the fairness opinion, did any of the information come from the party asking for it? If they did I independently verify it? And you better fucking do it. Okay. The Fairness Opinion Committee must have people who are not part of the deal. Makes sense, right? You can't just have people who are going to get paid on the deal doing a fairness because, of course, that's like asking a car salesman, is this car a fair deal? Of course it is. You have to have people not involved in the deal making the fairness opinion. Okay. A well-known seasoned issuer, this is for shelves. A well-known seasoned issuer has $700 million in float or $1 billion in debt issued, okay? They can use an S3, and then it's called an automatic shelf, an ASR. They are immediately effective. So if a WKSI is a WKSI, $700 million in outstanding shares or $1 billion in debt, they can do an S3, which means they're going to be automatically approved, effective, not approved, and they can use a free writing prospectus anytime, even before filing the registration statement. Okay. If an issuer has a bankruptcy in the past 3 years or a felony conviction in the last 3 years, which is a little crap, they cannot qualify for WKSI status. If a WKSI loses status after filing the automatic shelf, it can continue that offering until the next 10K is filed. Okay. A seasoned issuer, a little lower, needs at least 75 million. It's at least 75 million public float, not 700. So it's a seasoned, not well-known season. Okay. Now, if you want to buy in an IPO, you can't. You're taking this test, you pretty much can't. Firms, employees, finders, fiduciaries, portfolio managers are all restricted person. Restricted person and their fucking families cannot buy in IPOs under exceptions. So if you're a member firm, you must make a bona fide, meaning real, public offering at the price. Your job is to try to find it, okay? You cannot withhold securities for yourself or reward or threaten others to see your future business, okay? You cannot hold, it's called free riding withholding if you hold back some shares because it's a good deal. You cannot do that, okay? If you are renting with someone and you're not paying their bills, like your roommate, say you're younger and your roommate, they can buy an IPOs all they want, as long as you're not paying more than 25% of their annual support. So again, if you're splitting rent, who cares? But if you're paying more than 25% of their bills, meaning that more than your fair share, they're considered restricted. Other than that, roommates are fine. Okay. Client eligibility. So now, your job as an underwriter or salesperson or syndicate member, you have to update client eligibility to buy new issues every year, every single year, okay? Every single year. Now, restricted persons can participate in an account if their share of like a fund or a hedge fund is 10% or less of the total value. Okay. If a child is self-supporting, great. If you see the word self-supporting, you're kind of good, okay? But like a father dependent on the rep and living with them, that is going to be restricted. So if you see self-supporting, we don't care. Crowdfunding. This allows small businesses to raise money from many small investors. I don't know the number. I think it's 5 million. You can look it up. Might be 1 million. I have no fucking idea. Look it up. It limits how. So usually, if you're non-accredited, it limits how much you can invest at each time. It's like 10% of your net worth or income. Again, look that shit up. I think I have videos on it. Now, here's the big one. Crowdfunding purchases must happen through a broker-dealer or a crowdfunding portal. Okay, 147 is the intrastate, right? 80% of the revenues, assets, proceeds must be in the state. Only state residents can buy. No resale to non-residents, okay? Now, a partnership can buy on a 147 if the principal place of business is in the state. Now, that's 147. You can only make offers inside the state. 147A is pretty much the same thing, except for 147A, except for you only have to meet one of those revenues, assets, or proceeds in the state. And you can make offerings outside the state, but only issue to people in the state. This is like a website. Somebody in California, if I'm going to do something in Vermont, why I would, I don't know. But if I do it in Vermont, only Vermonters can buy it. But someone in California might see the offering, and if they live in Vermont, they can come back and buy it, okay? So the point is 147A allows a little more flexibility in the offering, but you still have to be in the state to buy it. Reg S, these are shares sold outside the country. So this is Reg S. The SEC has no jurisdiction. As long as no selling efforts inside the U.S., now, if they want to sell it, if somebody buys the shares, remember, non-U.S. person, so you can sell to a U.S. resident if they're living in another country. They can't be living here. If they buy it, they have to hold it either for 6 months or a year. If they're a reporting company, it's 1 year. If it's a non-reporting company, it's 6 months. If it's debt, because nobody gives a shit, it's 40 days. So again, if you buy shares of a Reg S and you're not in the country, you cannot sell it back inside the country for a year for equity or 6 months if it's reporting, financials, or 40 days for debt because nobody gives a shit about debt. So if you buy debt, in 40 days you can sell it in the U.S. If you buy equity, it's pretty much a year. Foreign broker-dealers can join the syndicate for the sales outside the U.S., even if they're not FINRA members. So if you're doing a Reg S and selling it to outside the country, foreign broker-dealers can do that even if they're not part of FINRA because they're not selling to U.S. people. Okay. This is going to be super heavy. Reg D, there's 3 levels, 504 up to 10 million, 506, anything 506 allows an unlimited dollar amount, but 506C limits to only 35 non-accredited, and then many unaccredited but no advertising. 506C, no unaccredited, but you can do general advertising. Okay, so what the hell is unaccredited? 1, 2, 3 accredited. 1, 2, 3 accredited. 1 million net worth, 200,000 a year single, 300 jointly. Okay, and remember your net worth excludes the home, officers, directors of that issuer, or if you have the 765 or 82. So pretty much anyone taking this test is accredited because you pretty much have to have the 7 first. You will have to sign an investment letter that you're agreeing to a 6-month lockup. Okay, Hart-Scott-Rodino. This is basically to look at HSR. It's a pre-merger notification. So basically, certain companies that are big, if it's 111 million or more, I think it's going to be higher in now. But it's a big company that allows the FTC to review for potential antitrust. Here's the deal: you file the SHR, you file the HSR with HSR, blah blah blah. You file it with Hart-Scott-Rodino, and then you wait 30 days. If you don't hear from them, it's passing, and you're good. So the filings are sent to the DOJ and the FTC, and it's 30 days. If they protest within the 30 days, then they get an extension. But if you don't hear from them, then then you're good to go. Okay, other random shit. Before crossing an order, you have to offer to the crowd in the stock exchange, okay? At least 1 cent above the bid. It's just a memorization thing. Okay, Rule 72 defines a block. What's a block order? At least 10,000 shares or 200 grand in market value. Now, market on close orders cannot be entered after. I have a video on this. You probably don't have to worry about this. So you cannot enter market on close orders after 350 unless there's an imbalance, and then there's rules. An over-the-counter security is generally any equity security not listed as an NMS, not traded on New York Stock Exchange or NASDAQ. Over-the-counter is like pink sheets, OTCQX, OTCQB, all that stuff. If it's not on an exchange, NASDAQ or New York, it's probably over-the-counter. I'm going back now. We're going to go back to Reg D a little bit. If you are a new partnership, each partner is considered in a separate. And remember, you can't create a partnership just to become accredited. Okay, remember that. So you can't create something just to meet the rules. So if it's a new partnership, I don't know the definition of a new, it may just created. Each partner is a separate investor. They all have to be accredited. However, it's an existing partnership that's been around, then the partnership counts as a purchaser. And if it's accredited, we're good to go. Now, usually you have to verify the accreditation, meaning accredited, by looking at bank or brokerage statements, tax returns, W-2s, Form 99. Okay. If you have, you have to hold it for 6 months. If you die, the holding period is waived. You can sell it during the holding period under 144A to QIBs, qualified institutional buyers. They are institutions with 100 million or more, or banks or broker dealers with more than 10 million. And once this 6 month hold is up, it can trade publicly. There's no volume restriction. Tender offer, tenderfoot. Tender offer is an offer to buy another company. Tender offer must be open for at least 20 days. If you make any changes, it's open for another 10 days, never less than the 20. You cannot. So if you make a tender offer, you cannot buy the stock, convertibles, or options during that tender offer. Short tendering, no short tendering allowed. Short tendering is if I make an offer to buy and you're short the stock, you can't do it. Now, if you own options or convertible stuff and you've issued exercise instructions for it, then you're long. But if you're not long the stock, you can't tender shares. So that's why they call it short tendering. If you're not long, you can't tender. If there's a tender offer, the management of the company being taken over or bought has to give an opinion within 10 business days. If you become an owner, you must file a 13D within 5 business days after acquiring more, not 5%, more than 5% of the company's stock, voting stock. Passive investors fall on 13G. Think D for devious, G for good. Insider trading, we don't like that. Remember, both the tippee and the tipper are liable. Inside information is not a problem unless you trade on it. Okay. And you get nailed for trading for profit or to avoid a loss. Civil liability is 3 times treble damages, 3 times the profit gain or loss avoided. Criminal, up to $5 million fine and 20 years in prison for an individual, and up to a $25 million fine for firm. And by the way, contemporaneous traders, anyone who's traded during that time can sue you for up to 5 years. Now, the exception to insider trading for insiders is what they call a 10b5-1. It's called an automatic trading plan. They're preset trades that you can set up, like the guy from Signature Bank. If you can say, listen, I want to sell my shares on the first day of every quarter for the next 3 years, I'm going to sell 10,000 shares. That's an automatic trading plan. So this way, there's no blackout periods. So what happens is you set it up to trade every quarter for the next two years or whatever. This way, if news comes out before or after, you can't change your mind. No matter what happens, you have to sell your shares on that day. Even if, no matter what happens. So what that does is that avoids sort of the problem of insider trading and blackout periods. Company buyback, 10b-18. Okay, if all buyback transactions on one day must be done through one market maker. So if I'm buying back for GM their shares, only my firm can do it today. Tomorrow they can do a different one. It has to be one day, one firm per day. Now, We can't buy back more than 25% of the average daily trading volume. You cannot buy shares on the opening or the last 30 minutes of the day or the last 10 minutes if it's an active trader. So again, you cannot buy in the opening trade or the last 10 minutes or last 30 minutes. 10 minutes for the actively traded stocks, 30 minutes for inactive stocks. You cannot buy higher than the last independent price or the highest independent bid, but you can never take the ask. So the highest independent bid you can buy it at, or the last sale. But if the last sale is the same as the ask price, you can't bid that. You have to take the bid. There's one exception. You can do a single block trade each week. Circuit breakers, baby. Then we're going to stop and start something new. Now, circuit breakers. If the S&P 500 drops 7% from the previous closing day, we shut down for 15 minutes. If it drops 13%, it drops for another 15 minutes. If it drops 20%, it shuts down for the day. Now, the level 1, 7%, and the level 2, 13 are only if it happens before 325. If they happen after 325, nothing happens until it gets down to 20%. 20% doesn't matter the time. Now, it can't hit it twice. It can't go down 7, up, and then down. You can only hit each circuit breaker once.